This is a special module in which we will be covering legendary Indian investors and their best and worst stock picks. In this module, we will be covering Ramesh Damani, K.N. Sivasubramanian and Gurpreet Kohli as our three legends, and will look at the economy-wide, industry-specific and company-oriented reasons behind their best and worst stock picks. Please note that the references of this module are taken from the magazine Outlook Business. The first investor that we would be covering here is Ramesh Damani, an absolute legend of the Indian stock markets. His best stock pick was United Spirits Limited, which is the spirit making arm of UB Group. He purchased this stock at around rupees 40 in 2003-04, and this stock rose to rupees 1400 in 2008. This was considered an absolute multi-bagging return on his initial investment. Now, while studying this particular stock, he considered economy-wide, industry-specific as well as company-oriented reasons. Predominant reasons were economy-wide and industry-specific reasons. Let us first look at the economy-wide and economic factors that were looked by Ramesh Damani while studying United Spirits. In 2003-04, after the technology boom of the 2000s, Ramesh Damani felt that India was moving towards a consumption-driven economy. In such an economy, consumer demand is the primary factor behind the growth in GDP. Consumer demand is that demand which happens when goods and services are demanded directly by the consumer and not by industries. After looking at economy-wide factors, Ramesh Damani turned a keen eye on societal and social factors that could lead to the growth of United Spirits. The young generation in 2003-04 was eager to go out and enjoy themselves. This could lead to an increased demand for the products of United Spirits, which primarily included liquor like whiskies. Therefore, this was another green light that United Spirits could be a good stock to purchase at the time. The next factor that was considered was industry-specific factor or industry-oriented factor. The primary industry-oriented factor in the case of United Spirits is that it was in the liquor industry or the liquor business. The liquor business is broadly a recession-proof business, as people drink in both good as well as bad times. These factors made it more lucrative or made Ramesh Damani more confident that he could place a bet on United Spirits. And these were also the key drivers of him going on and purchasing the stock. Now, there is a fun fact here. Well, while purchasing United Spirits, Ramesh Damani compared the company with its closest competitor at the time, Shaw Wallace. In 2003-04, this comparison was made, and ironically, in 2008, United Spirits grew that much that it went on to acquire Shaw Wallace. The worst stock pick in Ramesh Damani's career was state-run MTNL. He purchased this stock in 2001 at the price of rupees 150, only to exit it in 2008 and 2009 at in the price range of around 40 to 50. The primary reasons behind purchasing MTNL were again economic, industry-wide, as well as company-oriented. The primary economic factor behind purchasing the stock was the fact that the government in 2001 was focused on improving telecom connectivity in India. This led to reduction in license fee required to operate in the sector, as well as opening up the sector to many private players. The next factor that was primarily considered while purchasing MTNL were industry-oriented factors. The cost of making a phone call was lowering faster than ever. This was a prime industry-wide factor that was considered while studying MTNL. After looking at industry-wide factors, Ramesh Damani considered company-specific and company-oriented factors. To delve into detail of company-oriented factors, he broadly compared MTNL with other private players that were operating in this domain. This included comparing MTNL with Reliance, Airtel, and Idea, to name a few. Post this comparison, he felt that MTNL would be a good stock to bet on. Now, this is where the stock pick went all wrong. Private players like Airtel, Idea, as well as Reliance Communications came up with aggressive strategies of customer service, pricing, and growth. MTNL could not fight back this competition, and therefore the price of the stock went from 150 to 40 to 50, as the company did not perform as well as it was performing earlier. The next investor that we would be looking at is K.N. Sivasubramanian. The best stock pick of his career was HDFC Bank Limited. He purchased this stock in rupees 21 in 2001, and the fund that he purchased it for continues to hold the stock at 1258 in 2019. This made HDFC Bank a complete multi-bagger. A positive fundamental analysis led to the fund or K.N. Sivasubramanian purchasing this stock. While looking at HDFC, he considered economy-wide, industry-specific, as well as company-oriented reasons for purchasing the stock. The first economy-wide reason that he looked at was the fact that he too, like Ramesh Damani, predicted a consumption-driven growth in India. Again, we can recollect that a consumption-driven growth means that growth happens in a country due to increasing consumer demand. Around end 90s and early 2000s, many private banks were being set up in India. This included HDFC Bank, ICICI Bank, Axis Bank, as well as IDBI Bank. This setup of private banks meant that the economy and the government focus at the time was to improve the access to banking facilities for many Indians. This could mean that consumer or retail based banking would lead to a good avenue for business as well as growth in banking. After looking at the fact that the government was focused in improving access to banking and predicting that private consumer banking would grow in India, K.N. Sivasubramanian looked at the social as well as societal factors that could lead to the growth in banking. By looking at the current banking landscape, he realized that apart from state-run banks like the State Bank of India, foreign banks were also operating in the space. Foreign banks were private banks that were operating in the banking industry at that point of time. However, these foreign banks were more focused on the affluent urban consumer. Therefore, this reaffirmed the fact that there was a lot of space in terms of growth for Indian private banks like HDFC, ICICI, Axis and IDBI. Now, after focusing and getting getting down to the fact that the investment was going to be on the growth story of private consumer-based banking in India, K.N. Sivasubramanian realized that these private banks were going to be better run than state-run public sector banks. Let's recollect. State-run public sector banks include banks like SBI, Bank of Baroda, etc. Lastly, a competitive analysis of banks like ICICI, Axis, IDBI was done along with HDFC. From this analysis, it was concluded that HDFC Bank was the only one which had a laser focus on retail consumer banking. This was the primary reason why HDFC was purchased. And yes, it turned out to be a great investment. As for the worst stock pick of K.N. Sivasubramanian's career, it was Hyderabad-based Lanco Infratech. This stock was purchased around Rs 48 in 2010 and sold at Rs 36 in 2011. The primary reasons for purchasing this stock was again economic, industry specific as well as company oriented. The primary economic reason for purchasing this stock was that the government was focused at the time on improving infrastructure in India. After the crisis of 2008, the government through its banks started lending aggressively in the infrastructure space. The focus on lending to infrastructure companies to boost infrastructure growth was becoming a concern as infrastructure companies started becoming heavily indebted. Even Lanco's balance sheet was slowly becoming more heavier with debt. However, K.N. Sivasubramanian had previously tasted success in the infrastructure space with Larsen & Toubro and felt that he would be able to replicate this success with Lanco Infratech as well. Therefore, he went on to invest in the stock. However, the management quality of Larsen & Toubro as well as the way the company was run was far superior than Lanco Infratech, and this coupled up with the debt on Lanco's balance sheet was the primary reason for the failure of Lanco Infratech, and hence K.N. Sivasubramanian considered that Lanco Infratech was his worst stock pick. The next investor that we would be covering is Gurpreet Kohli. Now, it's important to note that both the best and worst stock picks of this investor were born out of fundamental analysis. However, his fundamental analysis and especially the approach to his fundamental analysis was unique, as this approach in both cases was not a traditional top-down approach where the economy was first studied, followed by industry and then company. And neither was it a bottoms-up approach where the company was first studied, followed by the industry and followed by the economy. The best stock pick of Gurpreet Kohli's career was Berger Paints, which he purchased at Rs 174 in March 2016, only to sell it at Rs 265 in October 2016. And indeed multi-bagging return for the short period that the stock was held. The beginning of his study was in industry specific factors. Around 85 to 90% demand for paints is replacement demand, meaning it comes from consumers who are looking to repaint their homes. After looking at industry specific factors, the next factor that was considered was social in nature. Due to higher disposable income, the average paint cycle for a household in India was dropping from 15 years to 10 years. This meant that on an average, consumers looked to repaint their homes once in 10 years. This was a primary reason that could lead to the growth of paints in India. After looking at social factors, the next factor that was considered was economy-wide. The government's increased focus on affordable housing could lead to an increased demand for paints in the country as well. Lastly, a comparison was made between Asian Paints and Berger. In this comparison with Asian Paints, Gurpreet Kohli realized that Berger was highly undervalued and hence was a good stock pick. Remember, a stock is undervalued when its intrinsic value is greater than its market price. The worst stock pick of Gurpreet Kohli's career was Infosys Limited. He purchased this stock at rupees 1110 in February 2016, only to exit it between rupees 1050 and 990 from October 2016 to March 2017. The first rationale behind picking Infosys Limited was industry oriented. The Indian IT industry had performed tremendously well post the recession of 2008. The second industry specific factor that was looked at was the fact that Indian IT companies had a global footprint which was greater than any other industry in India. After looking at industry specific factors, some economy-wide parameters were considered. Most Indian IT company earnings are export earnings, and the rupee was depreciating at that time. This could mean an increase in the earning of IT companies. Therefore, the fact that IT company earnings were from exports and that the rupee was depreciating further reaffirmed his faith in Infosys Limited. During the time of this investment, Infosys was compared with HCL and it was decided that he would invest in both these companies. However, soon after this investment, Infosys started facing some corporate governance issues, and as a result, its stock price went down. This marks the end of our learning module for the FMEP. Hope you had a good time learning this, and don't forget to implement your learnings in real time in the portfolio management module in the FMEP. Along with this, hope you can derive some insights from these learnings and implement it in your research project as well. Have a good time on Finlatics.